Have you ever asked yourself why the world's most famous investor, Warren Buffett, is holding a record amount of $150 billion cash reserve, which is the biggest cash position in his career? What if I told you that it could be a sign of an upcoming stock market crash? That is why, in this video, we will discuss the main principles that govern the investments of the legendary Warren Buffett, consider a rather unpleasant picture of today's markets, and reveal the truths that can help your investment portfolio avoid the worst. Wait for it and find out why pessimism for Buffett could literally be your ticket to riches. The exposures that Warren Buffett, one of the world's most famous investors, has achieved are as high as 19.8% per year from 1965. It means that if one invested $1 with him in 1965, that single dollar would culminate to about $42,000 today. Still, Buffett's current whopping cash reserves easily outweigh his stakes, which indicates an even higher level of bearishness on stocks. This means that unlike many specially trained professionals, he does not rely on gross economic indicators to determine market direction. Instead, he follows straightforward principles. The more that a stock costs, the more it becomes risky, and the opposite is also true, making the theory perfect. One fundamental factor that is evident from the investment philosophy of Warren Buffett is that they are simple. According to him, costly stocks are hazardous and should be avoided, while the low stocks provide higher expected returns. To some, this might sound like a fairy tale, but history proves that this is possible. A look at the S&P 500's 10-year returns over the past century reveals a pattern. Lowly valued stock is expected to give high returns to investors, while highly valued stock is expected to give low return to investors. One crucial indicator Buffett uses is the Shiller P/E ratio, developed by Nobel Prize-winning economist Robert Shiller. This ratio helps determine how expensive the market is. By shifting this ratio forward by 10 years, we see that peaks in valuations coincide with the worst periods of market performance. Conversely, low valuations align with periods of excellent returns. The Shiller P/E ratio's predictive value is evident when we examine historical market performance. Major downturns, such as those in the 1930s and 2009, occurred 10 years after peak valuations. Conversely, periods of high returns followed years when the market was undervalued. This insight would have helped investors avoid significant losses and capitalize on market opportunities. Today, Buffett's strategy reflects his view that the market is overvalued. He has increased his cash allocation and sold off shares of his favorite stocks. This conservative approach is due to the elevated valuations we see today, which suggest that long-term returns for investors may be very low. This can be explained by the fact that the present yield environment is nonetheless supported by Buffett's conservative approach. The return for holding cash gives approximately 5%, while the S&P 500 index's dividend yield is roughly 1.35%, and the earnings yield is approximately 4%. This has made cash a favorite destination ahead of stocks, a condition last witnessed in the year 1999. It is also well known that historically, when the earnings yield on stocks is less than the yield on cash, it is actually a bear market. The technical analysis provided by the experts in the market adds to Buffett's negative tone. As it stands, despite markets having their higher reaction highs, the technical indicators are gradually becoming bearish. It is always possible to find expensive or cheap stocks, but usually such categories of stocks are only valuable if they are expensive or cheap to a great extent. At present, the implementation of valuations is at the highest level recorded, which can only be compared to the situation preceding the crises of 1929 and 1999. Based on the used factors, one can conclude that the market is overvalued by a fairly considerable margin. For instance, the sum of Nvidia, Microsoft, and Apple's market capitalization now totals more than the economies of Great Britain, Germany, or Italy. This is the highest overvaluation level and implies that the market could be due for a major correction very soon. From the weather point of view of conservative investors, the present situation calls for a flight to quality. It is wiser to invest in bonds because today, bonds give 5% returns, while the stock market remains very volatile. It reduces the firm's exposure to uncertain market situations, particularly where there may be a collapse in the value of financial securities, while at the same time realizing relatively stable income from fixed income securities. Although long-term forecasts are conservative, short-term trends in the market can be quite unpredictable. They also stress the need to manage the risks well and always ensure that one has an exit plan on the trades.